We've just wrapped up an incredibly strong final week of November with most S&P 500 stocks jumping double digits, and as we head into December, history is on our side. Going all the way back to 1928, December has consistently been one of the best months of the year for the market, and honestly, this positive momentum is in fact needed, because when we zoom out and look at November as a whole, it was actually a pretty rough month, especially if you own some of the popular semiconductor names like Nvidia, like AMD, down around 15 and 18% respectively. On the other hand, healthcare investors are probably smiling right now with names like Eli Lilly soaring. That's up around 32% in just the last 30 days. But if we look ahead, in fact, December is also shaping up to be an incredibly huge month for the markets. All eyes are going to be on the Fed Reserve and whether we'll see a rate cut. JP Morgan, in fact, has now flipped and believes we will get a cut this month. And that's a view that's also echoed by the San Francisco Fed president, who almost never deviates from Jerome Powell. And of course, many investors are going to be hoping for a Santa Claus rally. It is something we've typically seen over the years, although worth noting we actually didn't get to see one last year. So in today's episode, we're going to be focusing on 7 high quality stocks to buy this month. We're going to break down our fair value estimates, the margin of safety currently on offer, and the key fundamentals you need to know. So let's kick things off with MSCI. Now this one is down around 8% in the last year. Year to date down around 6%. But over the last 10, this one has in fact massively outperformed the S&P. You'd be up 684%. Bear in mind, these figures don't include reinvesting those dividends, so if that's something you do, you'd be up even higher. They're currently trading around the midpoint of the 52-week range, where we get a weak buy rating from Seek Alpha, very respectable buy from Wall Street, 4.3, near the 4.5 to flip it into a strong buy with a hold from Quant. And if we take a look at the forward P, it's trading around 30. Now first things first, we never look at this model in isolation. We do couple it with other things in the investment thesis, but 30 is below the 5-year average of 38, so straight away we can see potential undervaluation signal. It's also trading at the lowest valuation in at least the last 5 years, but also we do understand straight away 30 in terms of forward P could look to be costly, and that's why we're going to take a look at the underlying metrics. Yield also sits at 1.3, which whilst you will argue is fairly trivial, it is above their 5-year average at 1.1. And if we take a look at the blue tunnel, which as always for newer viewers in particular highlights the expected fair price intrinsic value, we notice from the beginning of 2025 this one has been showing signs of severe undervaluation. Great to see as well the blue tunnel increase over time, and given disparity, that is why we would say potentially undervalued. Now if we zoom out to the last 10 years, this is pretty much what we would say is a model student. The blue tunnel has been increasing over the period. We notice it was trading pretty much from 2019 to around 2022 at a massive premium overall. And now we're noticing from around mid-2024 a discount to its fair price. This is where we would say potential opportunity has arisen. And very quickly for each one of these, we will highlight some of their underlying metrics. Firstly, again, model student free cash flow per share continues to climb consistently and expected over the next year. We see sales growth where in fact they've reported nearly every single year double-digit top line, 2024 sitting at 13%. Their top line in fact has also increased nearly 3 times over the last 10 years. And yes, we did touch upon their trivial yield, but just look at shares outstanding, it is climbing down. In fact, over the last 10 years, they've bought back nearly 30% of those shares outstanding. And as always, this does highlight when companies return excess cash to investor pockets. Again, another model student in terms of the ROIC, well above the minimum 10% we want to note, and continues to climb 34% on a trailing 12 month. Remember, for that point, we want a bare minimum of 10. That gives us faith management are able to effectively allocate their capital. And then we look at margins, again, very impressive, operating not only above the minimum, but continues to climb. Free cash flow also very strong, 46% noted on a trailing 12-month basis. Now, the only issue we would say, and it's not a massive issue, but something just to bear in mind and perhaps use a larger MOS, for the net debt to EBITDA, which highlights the number of years it would take them to pay off all of their debt, what we want to see is below 3. Now, that is what we get, and it does sit at 2.8. Ideally, we do want this lower. Projections hit 2.53 over the next year, but ideally, the lower, the more strength we can see in the company, as this also correlates to the balance sheet strength. Now, valuation grading, they do get an F, where we note it does sit above the sector median. You're paying a triple-digit premium, near 200%, but this is a high-quality company. We just showed you the metrics, probably one of the best, if not in the sector overall, so definitely deserves a premium. Question we need to answer is, how much of one does it deserve? And against their own 5-year average, as we just pinpointed, you are getting a discount. Now, price to earnings growth, that is what some investors want to look at. Typically, we say below 2 for a real opportunity. 2.76, it is on the higher side, sector much lower, but again, we just point out why that isn't a big issue. In fact, against their own 5-year price to earnings growth ratio, you are getting a 12% discount. And in terms of the growth grade, they do get a B-, top line up 9% last year, projected 11% this year. On both accounts, slightly higher than the sector, although slightly slower than what we are used to over the last 5 years. And earnings per share forecasted to grow 12% over the next 3 to 5, slightly above the sector. In fact, you could just say in line, but slightly less than their historical 13.6%. As we said, each one we're going to run it through our own intrinsic value, where we get to $683 on the DCF model. Now, firstly, we have the free cash flow year on year. Most recent increase was 21%. In fact, 10-year CAGR, that is 20%, is what we've seen year on year on average. We've gone for 14%, so straight away you could argue on the more conservative side, where we have a low, medium and high, 12, 14, 16 respectively, which as always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether for this one or any others. But on reverse DCF, that is if you're buying today at the market price, what is baked into the growth, we're noting 11.2, and if you believe that is too low, then undervaluation, maybe you see this as a little bit too high, then potentially you already believe this to be overvalued. Now, with the growth grade, we get the discount rate as well to give us the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding. That is how the 683 is derived, noting 21% upside. Now, if you believe, for whatever reason, you want to be more conservative, we're using two high numbers. Well, at 12%, 596, still upside, but in the single digit at 6%. And if you believe we should go higher, well, at 16, 781, 39% upside. As we usually do on the channel, we take through the middle rate, where we want to answer the question, what is the margin of safety on offer today? And that is staring us in the face, sitting at 18%. Remember though, on the channel, we do typically kick things off with 10%. We buy if it meets the 3 criteria: wide moat, strong financial metrics, good forward-looking data, all of which you could argue MSCI does have today. Wall Street, well, they see this at 665 into next year. That is 18% upside. And for those that want to see at a 20% MOS, well, a buy at 547 and at 25, 512. We'll also just flag, if you want to be more conservative and use the lower rate of 12%, naturally margin of safety is lower and it sits at the 6% point today. So stock 1, MSCI, let us know where you see it. Is it a buy, hold, or one to avoid? And before we continue, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now, as well as a copy that we're releasing later today for severely undervalued stocks for the month of December. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. So make sure you click below, you are signed up, to grab these copies and read straight away. The next stock we're moving on to, and actually the first time we've covered on this channel, is Royal Caribbean Cruises. Is up 9% over the last year. Year to date up 15%. Over the last 10 years, it is pretty much in line with how the S&P 500 has performed, and today sits, like MSCI, pretty much around the mid, although moving towards the lower end of the 52-week range, and we get our first triple buy across the board. Now worth highlighting, Seeking Alpha and Quant on the weaker side. Wall Street though, 4.3, that is near the strong buy rating. And this one does pay a yield pretty similar to what we noted for MSCI, sitting at 1.5%, with a forward P that does in isolation look attractive at 17. Now if we take a look at their underlying metrics, free cash flow per share, firstly we have to note that this business, like others in the industry, got hit very hard naturally during the COVID period, but nice to see from 2023 things have started to rebound. 2024, 765, projected to look very strong, more than double over the next year. Sales growth as well, we can in fact notice huge rebound once we got out of COVID, 477% increase to their top line. Naturally though, you would expect this to slow down, 19% seen in 2024, and total sales over the last 10 years have pretty much doubled. Unlike MSCI though, what we have noted for RCL is that they have diluted your position as a shareholder, not a massive amount, but actually over the last few years we've seen that trend reverse, and it looks, although very slowly, they are doing some share buybacks. ROIC looking consistently around the high single digit, 11% though in 2024, 12% again good on a trailing 12-month basis, and margins, whilst they did suffer during the COVID period, they look to have rebounded, staying strong, 26% for the operating, and on the free cash flow sitting at the 12% mark. And then finally, when we get to the net debt to EBITDA, remember 3 is the maximum we want to see. It is there or thereabouts on the trailing 12 month, but again, nice to see, like MSCI, it is anticipated to come down to 2.6. Now their valuation, where they get a D, pretty much telling us this company is now trading in line with the sector. They're also pretty much trading in line with their own 5-year average. If you want to see on a price to earnings growth though, 0.8 could be incredibly attractive, well below the sector at 1.7. That is a 53% discount, and their growth looks good. We're seeing an A+ year on year, top line up 9%, projected 12% moving forwards, well above the low single digit of the sector. And we can see over the last year, we just point out it was an incredibly strong year for them, and that is why we do in fact get the 5-year average skewed a little bit to the upside at 44%. Now earnings per share projected to look very strong, 21.2% over the next 3 to 5 years, and we can see that is significantly higher than the sector at 10. Now our intrinsic value, $309, again from the DCF. Their 10-year CAGR does sit 22%, although bear in mind, as we highlighted, a few years where it did take a massive hit, and we've gone for 12% moving forwards. Baked in reverse DCF, 9.4%. So if you're someone that believes actually these numbers are too high at 8%, we're actually looking at an overvaluation signal. At the middle rate of 12 though, we do get that undervalued level. So using the 12%, what we're actually noticing is a margin of safety around the 14% mark. If you wanted 20, well, a buy at 247, and 25 at 232. Now, Wall Street themselves see $340 into next year, 28% upside. So naturally, given our intrinsic value is quite some way below, they believe the free cash flow growth will be higher. If we input, for example, 14%, it comes to 345, not too dissimilar from where Wall Street analyzed this in terms of next year. So you could argue they anticipate around 14% growth for the company, and that actually the 12% middle rate we're using is very conservative. So let us know, based on a 14% MOS, is RCL maybe one to seriously consider? We then move on to Nvidia, which has actually taken a little bit of hit over the last few weeks. As we pointed out, this one was in fact down around 15% just in November, but still over the last year is up 28%, year to date up 32%, and as we've highlighted before, over the last 10 years, incredible performance, up more than 20,000%. Now it is still trading towards the upper end of the 52-week range, all-time highs $212, strong buy from Wall Street, hold although very near the 3.5 for Quant to flip this into a buy, and we notice here a weaker buy from Seeking Alpha at 3.8. Now the forward P does sit at 26, which is one of the lowest we can see over the last 5 years. In fact, the lowest valuation sits around the 25 forward P, and given it is below the 5-year average at 39.2, a potential severe undervaluation signal. And then when we take a look at the blue tunnel, one thing we love about this company is typically quarter on quarter after they release their earnings, we can see the blue tunnel naturally increase. That is why we get that upwards momentum, yet we're seeing the opposite with the share price. The disparity has only gotten larger in this period, and zooming out to the last 10 years, well, we can note, especially in the more recent period, Nvidia, because we do see their earnings very, very impressive quarter on quarter, we can see that the share price can't in fact keep up, and that is where we're getting the disparity, so potentially undervalued, even though the share price has been on a terrific run so far. And you're not going to be surprised to see incredibly strong metrics. Free cash flow will very rapid growth, 248 in 2025, projected more than double over the next year. Sales growth, again, very impressive, triple digit in the last 2 years, 65 on a trailing 12-month basis, and their top line, 5 billion 10 years ago, now sitting at 130. They've also recently announced share buybacks, which they continue to do, although at a very small rate, nothing massive for the time being, and ROIC 66% on a trailing 12-month, 71 for the full year of 2025. Very strong. Will be very difficult to actually see any company top that performance. And then margins also improving. We're getting massive efficiency, sitting at 59 on a trailing 12-month. Free cash flow also consistently very, very high, 42%. And when we look at the net debt to EBITDA, not only zero, but zero across the board, telling us for Nvidia it won't even take them 1 day to pay off all of their debt net of cash on hand. Now the valuation grading does get an F, but really what we want to point out here is on a price to earnings growth, they're trading at 1. That is incredibly attractive if you believe this is not an AI bubble. Ultimately, it's trading on the PG a 38% discount to the sector, but also 37% discount to their 5-year average. And their growth, as you would expect, impressive, 65% year on year, projected 73 over the next year, a lot higher than the high single digit of the sector, and also growing faster than they have done over the last 5. Now in terms of EPS, projected 37%, well above the sector at 15, but also expected to grow faster than their historical EPS at 29.8. Now intrinsic price is updated $214. This is based on the fact we've used the forecasted 2026 for their future free cash flow, and it probably should be fairly accurate given we have already seen quarter 1, 2, and 3, which ultimately tells us using a 20% growth rate moving forwards, $214 indicates 22% upside. And actually they've been growing their free cash flow over the last 5 years at 33%, over the last 10 at 56%, and baked in today is 16.7%, so we'll give you, as we say, a good idea. Now using the middle rate of 20%, you are getting an 18% margin of safety. If you want 25, buy at 160, and if you want 30, 150. Now, Wall Street actually see this higher than our projections, 258 into 2026. That is 47% upside. Now, if you want to be conservative and you want to use 15, well, actually, as you can see, you are looking at downside, but probably people are more on the other side when looking at Nvidia and believe that these numbers are a bit conservative. Using 25, well, you're talking about a 39% margin of safety with intrinsic value $287, but give us your views on Nvidia below. We then move on to one we haven't covered in quite some time, Palo Alto Networks, down 2% in the last year, up only 4.5% year to date, but over the last 10 years, another massive outperform of the S&P. The graph also looks good, consistently increasing from over the last few years, trading around the midpoint of the 52-week range. Now we do get a hold from Seeking Alpha and Quant with a respectable buy from Wall Street at 4.2, and these metrics are also very impressive. Free cash flow continuing to climb. Expectation is that that won't stop over the next year. Sales growth, whilst it is slowing down every single year, double digit, 2025 15%, and in fact they've been growing their top line at a ridiculous rate, 1.4 billion 10 years ago, now at 9.22, and we should make you aware they have been diluting your position, but you probably wouldn't care given how strong their performance has been. Now ROIC over the last few years has been sitting around the 10% level. That's also noted on a trailing 12-month. And margins, ideally we want to see them a bit higher, so hopefully we can see the continuation of the upwards trend. Free cash flow though, absolutely phenomenal, consistently for the most part in the 40% region. Net debt to EBITDA also looking incredibly strong, won't even take them, very similar to Nvidia, 1 day to pay off all of their debt net of cash on hand. And if we look at their valuation grading, yes, they're trading at a triple digit premium to the sector, but actually a 17% discount to their 5-year, and price to earnings growth 2.5 as expected above the sector, but actually pretty much in line with where they've been over the period. Now their growth gets a C- pretty much year on year and expected over the next 12 around the 15% point. Yes, it is above the high single digit of the sector, but actually slightly slower than what we've seen from them in the past, with earnings per share still looking very good, expectations of 19% above the sector at 15, but unfortunately slower than their historical sitting at 24. Now our intrinsic price gets to $259, where we can see they've been growing their free cash flow 22% year on year. We've gone for 16% moving forwards. On a reverse basis, it's highlighting 11.5, and you can see here the indication of 36% upside. If you believe it to be lower though, we're talking single digit, and at 20%, well, 78. Using the middle rate though, where we have 16%, which as always, you can grab a copy of the model by clicking on the pinned comment below, we're noting here 27% in terms of a margin of safety. Wall Street seeing $233, that's 23% upside. Now if you want to see it on the more conservative level at 12%, well, they're covering only a 3% margin of safety, and if you want to go the other way, for Palo Alto Networks at 20%, we can in fact see 44%. As always, do give us your views. Is it a buy, hold, or maybe one to avoid? We then move on to one of the worst performing stocks we've seen in quite some time, Novo Nordisk, down 54% over the last year. Year to date, down 43%. Over the last 10, this one has now underperformed the S&P, up only 73%. On a downward trend for more than a year, we can see all-time highs around the 140, 150 level, and it's trading very near 52-week lows. Interestingly, we're seeing analysts now flip a little bit more bullish. Whilst quant does have the hold, we're noticing seeking alpha on Wall Street not that long ago, they were sitting at a hold. They've now turned this company into a buy rating. Now it's also trading at one of the lowest valuations in at least the last 5 years, 14 versus 30, so potentially undervalued. Yield 3.5, significantly above the 5-year at 1.4, and the blue tunnel, as we can see, disparity only getting larger and larger, although we can actually note the expected price itself has been a little bit inconsistent and has started to, at least over the last few months, slowly dip, where over the last 10 years, this was one that was incredibly rare to see at a severely undervalued level. From 2021 all the way to mid-2024, this one was trading at a premium for such a long time. However, the script has changed over the last year. Now in terms of their metrics, free cash flow per share, well, we can in fact see increasing over the period, although expected to drop in fact over the next 12 months. Same with the sales growth, we are seeing a slowdown from the peak of 2023, but still trailing 12 month sitting at 17%, where when we do zoom out, their total sales over the last 10 years has pretty much tripled. Now shares outstanding, we are noticing one of the companies that we've covered today that are in fact buying back shares. Maybe as the share price has suffered, management will spend more allocation on doing more buybacks. And the ROIC, yes, it is trending downwards, but still, even 43%, that is very, very strong to see. Not many companies can hit those kind of levels. Where the operating margin, very high, but also increasing, 43, now at 49. And yes, free cash flow margin has been decreasing from 2022, but still 19%. Does look very healthy. Finally, net debt to EBITDA, not looking bad at all, 0.46 expected over the next year, now sitting at 0.47, and their valuation does get a B, 32% discount to the sector, 55% discount to their 5-year based on a forward P. Price to earnings growth, this is where the real issue lies at 5.7, 200% premium to the sector, 150% premium to their 5-year average, and their growth not looking great at an F, 17% year on year, actually expected to be around 8 to 11% based on their latest investor presentation update. Still above the sector in the high single digit, but actually Novo Nordisk had been increasing their revenues at a slightly faster historical rate. This is really where the issue lies. Analysts now only anticipate 2.4% growth to the EPS over the next 3 to 5, well below the sector at 10 and significantly lower than their historical 15%. Now, our intrinsic value at $55 does in fact come from a growth rate using 10%. Bear in mind their 10-year CAGR is slightly lower at 9, where baked in today sits at 7.9%, which is why when using a we're talking pretty much no upside. Now, if you agree on the 10%, you can see today you're getting 11% margin of safety. If you want to use higher at 20, well, it would be a buy around the 52-week lows of $44. At 25, a buy at 41, and 30%, a buy at 39. Now, Wall Street actually see this higher. They believe $61 is what we'll note in 2026. That is 24% upside. And if you believe, you know what, that does sound reasonable, well, that is all derived from roughly a 12% growth rate. As we can see, the prices aren't too dissimilar, and that in turn does give you a 21% margin of safety. So let us know, maybe you've been buying Novo Nordisk or it's one on the watch list. We then move on to Meta Platforms, which has had quite a nice recovery from what we saw in terms of the lows this month, up 13% over the last year. Year to date, down around 11, still massively as well, outperformed the S&P over the last 10 years. Trading, like most we've covered today, around the midpoint of the 52-week range. Strong buy from Wall Street, hold from Quant, and a 4 out of 5 buy from Seeking Alpha. Now they're trading at 22 forward P, so not far off hugely. They're 5-year at 23, so we could say a reasonable signal. And that's also what we note when we take a look at the blue tunnel, although it is sitting right there at the bottom end. It was around the $580, $590 mark not long ago, which is where we saw severe undervaluation, something we also highlighted on the channel. So as always, make sure you're subscribed, notification bell is on. We will always flag when these opportunities arise. And over the last 10 years, this one more often than not does anyway trade in an undervalued signal. So if this is one you're interested in the not too distant future. And then in terms of their underlying metrics, free cash flow per share was very strong, but we can note after 2024, it is expected to come down over the next year. Bear in mind they are anticipating to spend a lot continually on capex, and sales growth actually very strong, double digit every single year, bar 2022, and total sales naturally does show some very strong growth. They've also been doing share buybacks. In fact, we noticed from 2021 it has come down, and ROIC looking good, also an increase, now sitting at 26%. In terms of the margins, a little bit inconsistent, but you can't fault it whatsoever. 43% on the operating side, 24% in terms of the free cash flow margin, and net debt to EBITDA, very strong, nearly zero right across the board. Now, valuation grading at an F, we can see 62% premium to the sector. Price to earnings growth, whilst looks good at 1.5, that is a 13% premium to the sector, and pretty much in line with where they have sat over the past 5. And their growth does come in at a C+, 21% year-on-year revenue increase, expected there or thereabouts in the next year, well above the single digit of the sector, and also growing slightly faster than their own 5-year average. Earnings per share as well projected 16% over the next 3 to 5, above the sector at 12, but slightly below their historical 17%. And our intrinsic value still coming around the $800 mark, is using a 12% growth rate. Their 10-year CAGR sits at 24, and actually baked in is 9%. Bear in mind, for Meta, we have been conservative using the low rate of 12%. That in turn does give you a 19% margin of safety, where if you wanted 25, $599 would be the buy, as we highlighted not that long ago. If you wanted 30%, well, a buy at $559, not something we have seen in the last few weeks. Wall Street themselves see $845 into next year, 31% upside, and if you want to see the middle rate of 14%, well, $919, which does in fact indicate 30% for the margin of safety. So let us know for Meta where you believe this company sits. And then we move on to the high quality company again. MasterCard up 3% in the last year. Year to date up only 5%. Over the last 10, another massive outperformer against the S&P, trading around the mid to upper end of the 52-week range, where we get a weak buy rating from Seek Alpha, a near strong buy from Wall Street, and a hold from Quant. Now they're trading at a forward P around 30, which is slightly below the 5-year average of 32.6, so potentially undervalued. And that is also the signal we get when we look at the blue tunnel. Again, we covered this just a few weeks ago when it was around the $530 mark. That was showing clear undervaluation. Still does look like a good opportunity at the bottom end of the blue tunnel, where when we zoom out to the last 10 years, firstly, great to see the blue tunnel naturally increasing, and also very rare to see this in severe undervaluation. Really, we only noted this around 2023, and the metrics absolutely phenomenal. Free cash flow per share, very strong growth, not expected to slow down neither over the next 12. Sales growth nearly double digit every single year. Naturally, COVID year, we were anticipating a drop as we can see. And in terms of their total sales, well, a near triple over the period. Also, shares outstanding, very great to see they're doing share buybacks. It is something we know pretty much every single year. And ROIC, 54%. Now, whilst we have covered many companies today with very strong metrics, that is because we are looking at high quality companies. This isn't typically what we see for all companies we analyze. Operating margin well above 12%, 59 on a trailing 12 month. Free cash flow very strong, sitting at 52. And then net debt to EBITDA also looking healthy, 0.37 over the next year projected, and currently sitting at 0.42. Now grading, yes, they do get an F. You're paying a 200% premium to the sector. As we pointed out, a discount to their 5-year. Price to earnings growth slightly higher than we would love to see at 2.28. You are paying a triple digit premium once again to the sector. Against the 5-year though, as we can see, they have sat typically lower at 1.9, so an 18% premium. Growth looking strong, B-, top line up 16% last year, projected around 14, again above the high single digit of the sector. And we also notice growing slightly faster than their 5-year average, with EPS projected 15% growth, above the sector at 12, but below their historical 19.3. Now our intrinsic value gets to $661, where we can see the 10-year CAGR at 15%. We've gone 14, so that is more conservative. Also note, over the last year we can see here 25%, and baked in today sits at 11.1%. Now using the lower rate, yes, there is upside, but it is minimal, as we can see at 6%. And if you believe perhaps 16% to be where you want this company to be analysed at, 748, 36% upside. Now using the middle rate of 14%, you will notice a 17% margin of safety. Wall Street actually see this higher at 690 into next year. That is 25% upside. And perhaps you want MasterCard, well, 20% MOS would be 529, something we saw just weeks ago. 25, a buy at 496. Now we can also flag here for those that want to note, if we were to use the 10-year CAGR at 15%, it would sit around $700, not too dissimilar to where Wall Street see this, and that indicates a 22% margin of safety. So let us know your views on MasterCard today. Is it a buy, hold, or maybe complete avoid? And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets. We are, as we said, releasing December's copy very soon. And come and join us in the Patreon, where we cover our buys and sells. But as always, have a great day. We'll see you all on the next one.